Welcome to Beyond Wealth, Success Unscripted with Matt Calnan. Discover the personal drive, professional journeys, and business strategies that have made a real impact. It's success from the inside out.
Welcome back, everyone. Today we're chatting with Stephen Johnston. Stephen is the private equity managing partner at Omnigens Asset Management. Over the last decade, Stephen has built alternative funds in the farmland, SME buyout, private credit, and energy spaces with cumulative assets under management of more than $1 billion. So Stephen, welcome to the show, and maybe start us off with telling us about yourself and what you're doing.
Sure. Well, first of all, thanks for having me. A little bit more about myself. I come from a private equity background. Initial part of my career was actually spent over in Europe, investing for a bank called Société Générale, investing into the former Soviet Union, Eastern Europe, Russia.
Oh, wow.
I came back to Canada about 20 years ago with the idea of, continuing to make real asset private equity investments, but focusing on those areas of the market where Canada really clearly has a competitive advantage globally. And one of the asset strategies that I started now 17 years ago, and which has been sort of core to our business since then, has been investing in farmland. And we're actually one of the largest institutional farmland investment managers in Canada. We have about 125,000 acres spread across the entire country.
Yeah, quite large.
Yep.
Yeah, farmland's done okay in the last couple decades.
Yeah, I mean, and that wasn't an accident, right? It was,
Yeah.
We took a view of a number of macro drivers. We were in a negative real rate environment. You've got a lot of incremental demand coming out of the emerging markets for agricultural commodities.
Yeah.
And then on top of that, Canadian farmland was very inexpensive. And so, it wasn't by accident that we landed on that asset class. And it's been one of our core areas of investment.
Yeah. So that's the big focus right now, is that. And then I think it was on the SME buyout. That's another big focus for you guys.
Yeah. So, it's a big question, and I'll kind of try to distill it down. But we're always looking for a number of things. We want strategies to fit with our global, our macro view, that tend to be resilient in stagflation. And then in addition, we want a demonstrable value proposition, because no investment manager, no matter how good, or no strategy, no matter how good, can overcome a lack of value. If things are expensive, it's hard to make returns. And so, for instance, farmland, when we started 17 years ago, and even today, Canadian farmland on a productivity adjusted basis trades around half the global average. It's still very expensive.
Yeah.
And on the SME buyout side, we buy small, medium enterprises, like businesses that, you would acquire for about $30 million. Well, just to give you an idea of how inexpensive those are, you can buy that cash flow for 6 times.
Yeah.
Now you think about it on the Toronto Stock Exchange, cash flow trades for 16 times.
Yeah.
And so, and then we focus on industries which are resilient in stagflation. And I won't go into much more detail than that, but, those seem like different things, but actually in practice, they're the same thing.
Mm-hmm.
There's macro drivers, it fits our worldview, and there's value.
Yeah. Okay. And sorry, you're focusing on those 2 areas. Are you kind of out of the other stuff and just really in that niche area now?
Yeah. So we divested our energy exposure, and we divested our private credit exposure.
Yeah.
Actually, quite fortuitously, right before the real trouble hit, in both of those strategies. And we wouldn't go back into private credit or energy in Canada until there was real demonstrable value, which I don't know that there is there. I mean, the energy space has the regulatory issue, and private credit has the rate issue, right? And so, we're not one of those management teams where we have a hammer, and it's always a good time to invest in X. We kind of take the view that there's a good time, and then sometimes there comes a time where you should stop. And so we're perfectly happy saying, no, that's a strategy we're going to divest.
Yeah. And on the farmland side of things, so are you purchasing the farmland and then it's being rented out to farmers to go and produce crops? And there's probably a lot of people that aren't necessarily familiar with that model, but it's fairly large throughout Canada, and I think throughout North America as well. Is that correct?
Yeah, I mean, it's in Europe, it's the dominant model. There's third-party owners, and then most farmers lease. In America, it's a very it's a large part of the market is owned and then cash rented. In Canada, it's actually quite a small part of the market. It's still mostly farmers farming their own land. But I mean, it's growing as all things, right? I mean, we as an investor probably arguably have a cost to capital advantage in acquiring farmland because
Yeah.
we have scale and we have access to, lower price credit. And so, you'll see that consolidation process happen in Canada. The Canadian farmland market is very fragmented. Average farm sizes are sub 1,500 acres. That's very small compared to the rest of the world. So you'll see aggregation farms will get bigger, and we're just part of that process.
Yeah. And I think we've seen that quite a bit, probably over the last decade in particular, where a lot of that is getting consolidated and bigger consolidators are coming in. And it seems that from a farmer's perspective, it gets tougher and tougher to be able to afford the land from a production side of things. But we'll speak to that for sure if you'd like there.
Well, yes and no. I mean, there's a farmer out there in Western Canada with 400,000 acres.
Right. Yeah.
And so, like there are farmers, like non-financial investors, who are materially bigger than us. And so it's not so much, I think, that the land is unaffordable, because if it's unaffordable, then it should be unaffordable for us. Like,
Sure.
It's just like farmers have to embrace scale, and that requires a different mindset and different skill sets. And some farmers have grown very rapidly. So I think it's just more of a change in ethos. Like my stepfather's a farmer, and so then there's that consolidation is driving a different approach to farming. It requires scale. Like you can't operate a 1,500 acre farm with a modern suite of equipment because the equipment is so expensive, right? So all like the cost of inputs, financing structures, all those things are driving consolidation. And it's not like financial players in Canada are less than 1% of the market. It just really is farmers. And so farmers are driving the consolidation.
Yeah. Okay. Do you see the price of that farmland continuing to rise?
I mean, it gets back to that original thing. So when I think of farmland, I think of an asset that likes stagflation a lot. Like it likes inflation for the obvious reasons. It's the only non-depreciating commodity production asset on the planet. Like an oil well goes to zero, uranium mine goes to zero, gold mine goes to zero. Farmland does not. So it behaves in quite unique ways. So it loves inflation. It's a very asymmetrical payoff to inflation. But of course, doesn't mind stagnation either. It doesn't mind a recession because the demand for food is inelastic. People don't change their dietary behaviors. So we've got good macro for farmland. We've got excellent macro. The macro conditions are ideal. And then we still have a productivity pricing discount in Canada. We still have the price for a ton of wheat growing capacity in Canada is about $3,000 a ton. In the developed world, it's about $6,000 a ton. So as long as those two factors are there, we would continue to invest.
And that's a significant difference, right? When you're at 50 cents on the dollar compared to everybody else, pretty significant.
I mean, you've always got to come back to fundamentals when you're making a decision about whether to continue to invest in something, right? It's, there's supply and demand, there's the global macro monetary conditions, because there's the real rate environment you're in, there's the value proposition. And so when I think about Canadian farmland, I think that all the initial things that attracted to us are in place. Like the drivers haven't changed. They're still excellent as far as.
So all of your fundamentals of investing they're still there. It's what you want to see. And until that expires, which might be a long, long way away, it's still a solid asset. Yeah.
And it gets back to what I originally said, like we're not a dogmatic investment team. Some things have their moment, and then they generate returns. And then you arrive at a point where the fundamentals, that's obvious, it's going to be challenging for returns to continue. So, if Canadian farmland was $6,000 for a ton of wheat growing capacity, and we were in a non-inflationary world, I would say that you're going to get sort of the historical behavior of farmland, but you're not going to get that outperformance that comes from finding value. And so at that point, query whether we would continue.
Less upside on the investment overall. Okay.
Value is a very powerful return. Its value is mean reverting. Just is.
Within your firm, do you bring in outside investors, institutional investors, things like that, or is everything internally funded?
I wish it was internally funded because then I would be an extremely wealthy man. No, well, I mean, we have almost $1 billion of AUM. Like
Yeah.
our asset base is about half institutional pension plans, family offices,
Yeah.
and half retail investors, RSP investors. So it's a combination from the very
Okay.
small to the very large.
How do you do the RSP type approach? Is that through like a mutual fund trust? Is it public traded?
You can't, the publicly traded angle doesn't work for Farmland because of the ownership rules, but yeah, it's a
Oh,
mutual
okay.
fund trust. And
Okay.
then, excuse me, the fund is distributed through like all the mainstream broker dealers in Canada, Canaccord, Richardson, we're
Yeah.
working with BMO, all those other kind of people. So for the average investor at most broker dealers where you might have an account, you can invest through your RSP into the fund.
Okay. And do you have different funds set up for the different asset classes, or how do you have that
Yeah.
structured?
So we have two funds. We have one fund which is doing the, let's call it mid-market roll-up, buying businesses, and that's in a separate fund, and then the Farmland is in a separate fund, obviously because they're separate strategies. And so yeah, I mean they're kept legally ring fence. So we
Yeah.
effectively had two pools of capital. And the interesting thing about our funds is they're all evergreen. So they're all
Okay.
open-ended. Like most private equity funds have a start date and an end date.
Yeah.
Ours actually run continuously. And it's that's less novel on the real estate side. There are quite a few open-ended real estate funds.
Yeah.
But on the private equity side, that's very innovative. Most private
Very.
equity
Yeah.
funds are closed-ended. Yeah.
Yeah. Yeah. And they're looking at that shorter, that 7 year, some up to 20 I've seen, but most are on that shorter side, right?
Yeah, and I don't think that works for the business. I mean, what we have done, and it's taken a long time to, get all this skill and technology together, is we're effectively running like an assembly line of roll-ups. And for the people that are listening and not familiar with the term, a roll-up is when you buy a single company, say, like we have an auto maintenance roll-up. So we have an auto maintenance platform in Ontario that has 40 locations. And then we continue to buy auto maintenance companies until you build one single bigger auto maintenance company. And the beauty of that is it takes time. It takes 2 or 3 or 4 years to do it. You
Yeah.
have to do all the integration. Sorry, there is an answer here. It's long-winded. I apologize.
No, no.
Um, um, and then, you go from being able to buy cash flow at 6 times and you can sell it for 10 because you've integrated it and made it much bigger. Now and then what you want to do is have an assembly line of those. You have another one behind, which is environmental testing, and another one behind, which is, casual dining, or another one behind whatever it might be. And so you can't do that model. So you have continuous building and selling of these integrated pieces of cash flow. You can't do that in a traditional private equity fund because it's start and then in
Yeah.
7 years sell everything, regardless of whether they're ready or not. So
Yeah.
we moved to going open-ended to allow that process because it generates very high organic rates of return. You can buy for 6 times, so you can generate a very high distribution, and in 2 or 3 years you can integrate and sell those assets, and then just recycle the capital and continue.
Right.
So
So you're getting kind of the best of both worlds on it.
it's a much better approach than the
Yeah.
traditional buy, hold, sell, liquidate the whole thing.
Do you now, because it's an open-ended fund, do you keep liquidity events within there then?
Yeah, so you have to obviously, no one wants to be in forever.
Yeah.
And so there are contractual hold periods. They range from 1 to 4 years.
Yeah.
And then there's quarterly liquidity that you can get after those points. And then the fund just has to manage liquidity. You've got incoming capital, you've got access to asset dispositions, you've got access to credit lines. We don't actually use a lot of leverage in our funds.
Okay.
The one thing I don't, yeah, like I'm philosophically opposed to leverage.
Yeah.
Because it's this, I'm going to watch what I say. I think that philosophically it's not good because most people who invest have their own leverage. Like they've got a, so they're already levered.
Yeah.
And if leverage increases their returns, the manager benefits.
Yeah.
If leverage blows the fund up, the manager doesn't suffer the consequence. Like there's no financial consequences. And so, so a lot of managers have great track records, but if you de-lever their returns, they're actually not that good.
Yes.
And so like we our, like when we publish return information, we always publish the unlevered return information. So people can,
Interesting. Okay.
because it's much more honest. It's like, what did we intrinsically generate as a return without the use of financial engineering?
Yeah.
And so a lot of, like, you see asset classes that are having a great run, and they're attracting a lot of capital and the returns are excellent. But what is hidden in the mix is that they're also incorporating a ton of leverage to do that.
Yeah.
And so to look at those returns and not to discuss the leverage is to look at those returns and not discuss the risk.
Sure.
That's effectively what you're doing, right?
Yeah. Yeah.
And so we just philosophically don't use a lot of leverage. We use leverage to manage cash, but that's it.
Okay. And just as a high level, just for anybody listening that might not fully understand that, when we're talking about leverage, we're saying going and getting bank debt. So let's say we buy an asset at $10 million for easy math. Maybe you go and get bank leverage of 5 million, meaning taking on 5 million of debt. You get 5 million of equity or some other instrument to finish off that purchase price. So you're 50% levered on that business because you got 50% debt. What you're saying is you would rather go and use 10 million of the equity side instead of using any debt, which is inherently must lower the return because you're doubling the amount of equity for the same cash flow, or there's some interest and whatnot calculations in there, but effectively you're cutting it in half.
Yeah, we use a little bit of leverage, but the thing is, if you're really diligent in finding a discount, if you find a value proposition,
Yeah.
you can generate good returns. You don't need leverage. Like you can generate like imagine, just to go back to the buying companies example, we can buy these, mid-market companies, lower mid-market companies for 6 times cash flow. So it's generating a 16% annual rate of return already. Like it's a cash on cash return.
Yeah. Which is a very strong return.
It's a very strong return. So you incorporate a little bit of leverage to manage cash flow, but you don't need a lot to make a compelling return profile. And then if you get the jump from 6 to 10 on the earnings multiple, you generate another 10% a year. You can generate very high rates of return.
Yeah.
And so I don't want to disparage other strategies, but leverage, really high levels of leverage are typically implemented in strategies where there's no value. That the only way to get the returns up is to really lever them using inexpensive debt. That's why when rates go up, use the old expression, you see who's been swimming naked is the expression, right?
Yeah.
So because when rates go up, it reveals who is buying inexpensively, who is generating organic returns, and who isn't.
Yeah.
And that's when bad things happen. Leverage isn't free. It increases return volatility, upside and downside.
Yeah, for sure. For sure. Yeah. Okay. What, do you guys have a return of capital component in there as well? Are you able to do return of capital versus just straight distributions?
So no, there's no tax efficiency. I mean, they're all flow through vehicles. And so when you're buying businesses, it's income until we actually sell one of the holdings, you integrate it. So that's a capital gain, but the run rate, normal distributions, we call them, the monthly distributions, those are income. And then when you sell a vertical, we haven't done it yet, you sell the auto maintenance platform, that would be a gain.
Okay. Yeah.
And then on the farmland side, we don't make distributions. It's just all we reinvest cash flow, buy land. So it's just gain.
Yeah. You're looking at the upside of the growth of that land long term.
Yeah.
Which I would assume is quite typical when you're looking at land as the underlying asset that you're purchasing.
Yeah, we're not operating farms because once again, you pick up volatility you don't get paid for. That's just, you've reduced your risk adjusted returns. So we have cash rents, but they're only about 20% of the returns. If you look at farmland historically, like 70 years, 80 years of data, about 80% of the returns to farmland are from land appreciation. People you go, why? That's kind of unusual.
Yeah.
But I've already touched on the why. It's because farmland's the only non-depleting commodity production asset.
Yes. Yeah.
So it's discounting the production of an infinite series of crops. It's discounting the fact that crops will be produced forever. And so that's why it behaves so strangely, right?
Yeah.
It's actually, and I hesitate to allow people to date me. But I've been in this business for a very long time. And when I started to research farmland, its behavior was really counterintuitive. It's really unusual. It's basically, you could put farmland in your portfolio and generate the same long-term rate of return as the S&P 500
Yeah.
with half the volatility.
Yeah. Yeah.
You
Makes
know,
sense, right?
yeah, the S&P is like everybody's lodestone. It's like you have a cornerstone investment in public equities. Well, farmland can replace that allocation and cut your volatility in half.
Yeah. Yeah.
That's almost a free lunch. I hesitate to say it. Like there's no such thing, but you know what I mean? That's a good swap, right? Is to swap out some of that asset for this asset.
Yeah. And I would say as long as there some of the volatility that comes from the market also comes with extra cash flow compared to what a land holding would be as well, though sometimes, right? So there is, if people are looking for a pure cash flow investment, it's tougher to get that out of land because we're really banking on that appreciation side.
Yeah. But once again, once you're in a structure where you can exit on a regular basis, you can generate synthetic cash flow. You just redeem.
Very true. Yeah.
Right. So, I mean, I'm
Yeah.
comparing the S&P with dividends to
Yeah.
farmland. So that's an actual like-on-like comparison. Yeah, and like most stocks now, publicly traded equities don't actually yield that much.
Yes.
In any event. But once again, I'm also not saying to somebody, you know, farmland has a great Sharpe ratio. Farmland has a great risk return profile. Sell everything you have and go 100% farmland. I like that. It's something to consider incorporating into your portfolio because it gives you stagflation insurance.
Yeah.
And a lot of it, like in the 1970s, farmland in Canada went up 400%.
Yeah. Yeah.
And commercial real estate and stocks were down at the end of that decade.
Yeah.
Because people believe, actually, do you mind if I digress? I've been nothing but digressions.
No, please
it's been
do.
one long digression, but there's actually this misconception. There's a belief, and it's quite common, and maybe it's self-serving, that publicly traded equities and commercial real estate hedge inflation perfectly. And it's actually a little bit nuanced. They hedge low levels of inflation virtually perfectly. But what they do not hedge, and the historical data is like very clear on this, high levels of inflation or volatile inflation do not hedge it at all. And so just to make that concrete, in the 1970s, at the end of the decade, the S&P was down 30%, 40%, the nominal, and commercial real estate was also down. It did not hedge that stagflation.
Mm-hmm.
And if you'd have incorporated a 5% allocation to farmland, you'd have, because it hedges stagflation so well, you'd have hedged all of that risk.
Really? So taking out all of the losses just with that 5%
So
holding.
That's what I mean. It's like really good stagflation insurance. In fact, one of the reasons we get a lot of interest from institutional investors is that they have a really big challenge. Because imagine you're managing $400 billion,
Mm-hmm.
and it's all set up. It's been invested over 20 years with no worries about stagflation.
Yeah.
No worries about inflation. And now you're going, there is a non-zero risk that stagflation may be 5-10 years. But how do I move a $400 million portfolio to hedge that risk? Like, because it will require enormous changes. And so they're out actually now in the market looking for asymmetrical, payoffs, like things that are really do well in stagflation. And so they do approach us purely for farmland's behavior in stagflation, because you start to layer in that asset, you get a lot of stagflation insurance, if you want to call it that. And then in Canada, you get value and all those other things. But so that's actually a lot of the reason for institutional interest in the asset.
Yeah, that's really interesting. And I mean, again, just the fact that you said, in the 70s, holding just 5% of it helps you offset all the other volatility that happened. Those are asset classes that you want as part of that diversified strategy, right? And I assume, like, you're not saying somebody should hold 80% farmland. Again, it's just that diversified type of asset.
Here's the challenge. Like, for your listeners who are familiar, we did like an efficient frontier, which is like to minimize the risk, maximize the return. And we looked at a 60-40 bond equity portfolio. Yeah. Well, because of farmland's behavior, it said sell 95% of that and buy farmland. Right. We can't in good conscience recommend anybody do that. Right? And so, but farmland, that just gives you an idea of how, like, how unique farmland is as far as financial behavior, that it tells you to do that.
Yeah.
There's a big US firm that has billions of dollars of farmland. They did the same analysis and they had to artificially cap it at 20% because
Oh,
it
so
just,
it wouldn't push the
so,
model's not going to push it up. Yeah.
yeah, the model takes you basically, it goes sell everything you have and buy. And I'm not saying that because, of course,
Yeah.
you, like return is the reward for taking risk, and risk is just not knowing what the future is going to be. And so no
Yeah.
one can predict that farmland will continue to behave like it has, and et
Yeah.
cetera, et cetera. But it is interesting. And it gets
Yeah.
back to what I said originally, that we look for those three things. There's a macro driver, there's value, right? And then there's a set of, like, that we can integrate and acquire the asset and all those other things. And so if you get
Yeah.
those right, you typically generate returns. You can
Yeah.
still mess up, but you typically have a tailwind.
Yeah. And you're not, again, like for the average person, they're not going to be able to go out and buy, you know, 1,000 acres of farmland or whatnot. So what you're saying is you guys have set up these funds that are accessible from the public side to be able to go in and invest via that mutual fund trust in an RSP, so a protected vehicle, and be able to buy a piece of that farmland that you guys are now a part of to help diversify their portfolio. So we're not saying go out and buy a bunch of acres of farmland and try to rent it out.
No.
It's being part
And
of
in
that
fact,
fund.
this is one thing I will be emphatic on. Like a farmland fund is a fund in farmland actually provides something like genuine value in the form of diversification.
Mhm.
You like farmland is one of those assets where you genuinely need geographic diversification, like
Yeah.
like unambiguously, right? And
Yeah.
so
Yeah.
if you went out and bought 1,000 acres, you have one operator in one location, you're exposed to the weather risk of one location.
Yeah.
It's genuinely a bad idea. And so
Yeah.
diversification has been described as the only free lunch, and it is. It's a very powerful impact of investing in a farmland fund. Like you if anybody hears me speaking and says I really like farmland, like I'm adamant about this. Do not go out and buy a single block of farmland. Like
Yeah.
that's
Yeah.
it's genuinely. I'm not saying you should invest with us. It's the flip side, but I'm saying don't do that. Like
Yeah.
that exposes you to a lot of risk.
You're not doing the diversification really at all at that point. You're putting yourself in the opposite
Yeah,
direction. Yeah.
yeah. It's
So
like it's genuine value. There's genuine value in going through a fund, which can
yeah.
provide diversification.
So on that diversification topic, then where are you guys located from a farmland perspective, and where are you looking for more?
Yep. So 80% of Canada's farmland is Alberta, Saskatchewan, and Manitoba.
Yeah.
And our portfolio construction models overweight Saskatchewan and Alberta, and that's a conversation for another day. And then we underweight the rest of Canada. So all of our land is in Manitoba, Alberta, and Saskatchewan, but that's geography almost the size of Europe.
Yeah,
It's
it's
enormous.
huge.
There's
Yeah.
there's 3,000 acres between our two furthest pieces of farmland.
Got it.
And then
Yeah.
we're looking to add in Ontario because parts of Ontario are properly priced from a productivity basis. Basically, it's by the Manitoba border.
Yeah.
And then potentially in British Columbia, and that's what our portfolio model tells us to do in Canada.
Got it. So if someone were to look at investing in your fund, you know, if they got a broker, they've got somebody like that, financial advisor helping them out. Now, just as a preface, a lot of financial advisors, and this is something that probably a lot of people don't know, a lot of financial advisors aren't able to invest in a product like this. And it's one of the challenges I have with financial advisors. I don't think they tell their clients that all the time, that they're not actually able to invest in products like this. But if somebody was interested in investing in your fund, what are the steps? Like, what do they need to do? Who do they need to go talk to on that?
Yeah, and so we're not a registrant, so they have to go to a registrant, as you point out.
Yeah.
But we have distribution relationships with a lot of Canadian broker dealers. You would know their names, like the Canacords and the Wellington.
The big ones. Yeah.
Yeah, all the big ones. And some of the bank dealers. And so once it's approved on the shelf, you just ask your advisor about it, and they can literally just there's some fairly straightforward subscription agreements, but
Yeah.
they just go into FundServe. It's a clearing system, and they just move your cash around. So it's quite automated. And actually, in practice, the Canadian market has lagged in the use of alternatives at the broker dealer level, but that's changing quite rapidly. I think that they're all starting to realize that they have to offer these things because it's basically best practice. I mean, big institutional investors have been doing this, for a long time.
Yes. Yeah.
And purely from the perspective of just diversification, like it adds
Yeah.
different return drivers into your portfolio. They should be under consideration. And there are now a lot of seasoned alternative managers in Canada that have long track records, that are trustworthy. And so I think it's actually changing quite rapidly. But I do take your point. Like 10 years ago, it was impossible.
Yeah. Yeah. Well, definitely. And that's one thing that the security commissions have, I think, done an okay job on is freed up some of those opportunities through exempt market dealers and whatnots. But it is one of those things where it's easier now to get into those types of investments than it ever has been. And I've also seen a shift, like when you look at the big funds, the institutional investors, even like CPP, the Canadian Pension Plan or the Canadian Pension Fund, if you're looking 20 years ago, they were really following that 60-40 model fairly closely, or maybe 30 years ago, where your equities is 60 and your bonds and market products are 40. But there's definitely been a shift on that. And it's probably closer to like a 40-40-20 now. And that 20 is being added in that alternative investments or the alternative asset class, which is real estate, land, gold, silver, those types of products in there. And I think we're starting to see individuals start to shift into that mindset as well. To your point on the diversity side, that's really important, right? The diversification of the portfolio. Well, this is a great asset class on the alternative investments to help that diversification. So I think we are starting to see that shift over.
Yeah. And I make one observation. If you want to make suboptimal returns, invest in something that everybody's invested in. And if you want to make optimal or super optimal returns, find something that no one is invested in. Now, sometimes no one's invested in for a reason, that it's terrible. But it's far more difficult to make a return. And this is back to the value proposition, where it's been financialized, because typically there's pricing isn't good. And hence, we don't buy $6 billion companies, because you have to it's 20 times cash flow to buy a company that size. You work to buy small companies and get the cash flow inexpensively. There are other challenges with that. There's lots of moving parts and lots of companies. But if you buy cash flow inexpensively, you're likely to generate a return. And it's the same thing on farmland. You can buy it in the States or buy it in Australia for $6,000 or $7,000 for a ton of wheat growing capacity, or buy it in Canada in the prairies for $2,500. Because the Canadian farmland market is underinvested. The Canadian private equity market, particularly in the mid-market level, is underinvested.
Yes. Yeah. I've seen that as well, for sure. So, Stephen, if people wanted to learn more about you or connect, where would they find you at?
Well, they can start off with just reaching out to me, and then I can, depending on their questions, direct them to the right place. So I can give you my email, or what's the process?
Yeah, whatever you'd like. Yeah.
Sure. So it's sjohnston, SJOHNSTON at Omnigens, OMNIGENCEAM.com. And then I can point you to the right person to answer your questions.
And just to preface this one, so you don't get a bunch of questions about investing, you cannot provide investment advice. You cannot provide investment support. They need to go to a broker. You can direct them to a broker, but you're not able to provide that advice for them.
No, I can only talk about our investments, and I can't make recommendations. And you're always better off talking to a third party in any event.
Yeah, for sure. Well, we certainly appreciate having you on the show. That was a fantastic chat, and look forward to catching up soon with you.
Thanks very much.
Thanks very much, Stephen. Bye-bye.
Cheers. Bye-bye.
You've been listening to Beyond Wealth, Success Unscripted with Matt Calnan. Want to be our next guest? Visit beyondwealthpodcast.ca/guest. See you on the next episode.